Welcome to Smart Stock Watch, your go-to channel for in-depth financial analysis. Today is February 6th, 2025, and we're diving into the latest earnings report from Performance Food Group, a leading food service distribution company in North America. Joining us is John, senior analyst from Smart Stock Watch. John, thanks for being here.
Thank you for having me. Performance Food Group, or PFG, has just released their second quarter fiscal 2025 results, and there's a lot to unpack, from strong sales growth to strategic acquisitions.
Revenue and profitability overview. Let's start with the top line. Performance Food Group reported net sales of $15.6 billion for the second quarter, a 9.4% increase from the previous year. John, what are the key drivers behind this growth?
The growth in net sales was primarily driven by recent acquisitions, an increase in case volume, and a favorable shift in the mix of cases sold. Additionally, inflation contributed to higher selling prices per case. Gross profit also saw a significant increase of 14.4% to $1.8 billion, thanks to procurement efficiencies and a favorable sales mix.
Despite these positive figures, net income decreased by 45.8% to $42.4 million. What factors contributed to this decline?
The decline in net income was mainly due to a substantial increase in interest expenses and a decrease in operating profit. However, it's important to note that Adjusted EBITDA rose by 22.5% to $423 million, indicating strong underlying business performance.
EPS performance and analyst expectations. Performance Food Group reported an Adjusted EPS of 98 cents, which is below the forecasted $1.03 from a survey of 6 analysts. John, how should investors interpret this?
While the Adjusted EPS of 98 cents represents an 8.9% increase from the previous year, it did fall short of analyst expectations. This shortfall can be attributed to higher interest expenses and increased operating costs. However, the company's strong sales and EBITDA growth suggests that the core business remains robust.
Strategic initiatives and acquisitions. Performance Food Group has been active on the acquisition front, with recent additions like Cheney Brothers and Jose Santiago. How have these acquisitions impacted their performance?
The acquisitions have significantly contributed to the company's case volume growth, with total case volume up by 9.8% and independent case growth at an impressive 19.8%. The integration of these acquisitions has gone smoothly, adding value and expertise to PFG's operations, which is a positive sign for future growth.
Operational efficiencies and future outlook. Operational expenses increased by 17.2% to $1.7 billion. What are the main factors behind this rise, and how is PFG managing these costs?
The increase in operating expenses is largely due to recent acquisitions, higher personnel costs, and professional fees. However, a decrease in fuel expenses has helped offset some of these costs. Looking ahead, PFG has provided strong guidance for fiscal 2025, with expected net sales between $63 billion and $64 billion, and Adjusted EBITDA ranging from $1.725 billion to $1.8 billion.
Key takeaways. In summary, Performance Food Group has delivered strong sales and EBITDA growth, although they missed the EPS forecast. Their strategic acquisitions and operational efficiencies are setting a solid foundation for future growth. John, any final thoughts on PFG's investment prospects?
PFG's robust sales growth and successful integration of acquisitions make it a compelling investment despite the EPS miss. The company's strong guidance for fiscal 2025 further supports a positive outlook. Investors should keep an eye on how PFG manages its operating expenses and interest costs moving forward.
Thank you, John, for your insights, and thank you to our viewers for tuning in. If you found this analysis helpful, please like, share, and subscribe to Smart Stock Watch. We'd love to hear your thoughts on Performance Food Group's performance in the comments below.